Okay, so we're back, and just to recap, we've gone over categories, we've gone over valuation, we went over the trend, and we also talked about fundamentals. So we covered a number of topics, and we're going to now finish off day one with a picture is worth $1,000,000, we call it. This is sort of our initial entry into the technical analysis section of the workshop, which will go into the next day as well. But we're going to end with starting this off and kicking off into some technical analysis. And want to point out that we're looking at continuation patterns. When we look at these technical chart patterns, we're not trying to find the stock that is going to go from stage one to stage two. We're buying stocks that are already in stage two and corrections within that uptrend. So we want to see the stock already in an uptrend. So we're never buying at the lowest price. And that's not what we're trying to do. That's not the goal. Our goal is to buy at the right price, as I pointed out before when we talked about trend. So what, in order of importance, the long-term trend is most important, because if you don't have the trend in place, then you shouldn't even be looking at the stock. It shouldn't even come up in your work, because that's the non-negotiable criteria. That's the qualifier, right? We talked about that. Now, the next is the current price action, looking at that current chart pattern and what that current price action is telling you. And then we're going to look for a low-risk entry point, and that's going to come a little later on. Right now, we're going to look at the current price action. And some of the names that we have for these patterns, some are unique to me that I've termed them, and some of you have already have heard of these: a cup completion cheat, a load cheat, a cup with handle, of course, has been popularized by William O'Neill. Prior to that, it was a saucer and platform. William Giller coined that. Double bottoms, Darvis boxes, and power plays, which are also high tight flag type names, which we're going to go over those too. There's a particular section on power plays. So we're looking for these continuation patterns, and we're buying near new highs, usually within 20 or 25% of a new high, or even in new high ground. Dave, let's talk about some of the reasons why you would buy going into new high ground. This chart of Microsoft, these little black dots, just show each time the stock made a new high. If there's no black dot, then it's not making a new high. Obviously, it's either going down or moving sideways. But what we can see is here, and what the important thing to show, and this is Monster Beverage, is that you can't make a big move in a stock without making new highs. It's impossible. All right.
Right.
So there's some other reasons too. What are some of the reasons, why we want to buy in near new high ground or in all-time high ground, Dave?
Well, one of the most important reasons is that there's no one higher than where you're buying. So there's no, quote, overhead supply. Everybody that is buying or everybody that holds that stock when it goes into new high ground is at a profit, and there's no one ahead of you, and so everybody is happy. The only people that would be selling are people taking a profit. But if you're buying, let's say we're looking at Monster. If you're buying right in this area, right, I got to get my arrows correct. If you're buying right in this area down here, well, you've got this overhead supply of which there might be people who bought here who are underwater, who, as it gets back there, might sell, and so it might hold the stock down. But if you're buying when the stock is hitting new high ground, well, right here, there's no one above you. And so that's one main reason. The other thing, just think of it logically, if a stock's going to make a move from $20 a share to $120 a share, it has to be making a new high every penny on the way up. So.
That's right. And let me show you something that people don't really realize, that the real action, or actually, let me move over here. Let's look at Yahoo. We're on page 104. So a stock's future is in new high ground. And even if you were to buy a stock, let's just say you bought a stock down, you were able to pick the exact low after a stock dropped, let's say 50%, right? It gets really clobbered in the bear market. It's down 50% and you buy it right at that low. Okay. And then it comes back and it comes all the way back to where it makes a new all-time high. So if the stock went down 50% off its high and you pick the absolute low, what percentage would you make if it went back to the old high? 100%. You would double your money, right? A 50% drop takes 100% gain to get even. So if you picked the low and you got it back to new highs and it went to new high, you sold it, you would have made 100%. But take a look. That's only 100% from the low back to new high ground. From that point forward, every point higher, every quarter of a point higher is a new high. So the real action happens in new high ground. So you can make, even if the stock's down, let's say it's down 60 or 70%, maybe you make, it goes up a few 100% off its low. But many of these names go up 10,000, 20,000, 50,000, 100,000% over 2, 3, 5, 10 years. So here's an example of Yahoo, where coming off the lows back into new high ground makes 170% move. But then from the new high ground, it goes up 4,300%. And even much higher, right? So the real action is happening and the excitement is happening in new high ground. Here's Taser after a huge decline and a big move of over 500% back up to new highs. And I'm buying it over here. I think I'm buying it over here, actually. You can see in just a year or so, the stock goes up more than triple what it made from its low to the new high, but in new high ground, it goes up 1,800%. So this will be the story of any stock that makes a very big secular move. You'll see it, all that move, or a good majority of that move, is all going to be in new high ground. So you can't have a big move in a stock without going into new high ground. So you have to get used to being comfortable in new high ground.
Yeah, and if I could add just two other things, is that you want to be buying when it's going into new high ground off of a base. See, like with Taser, this is a stock that had been going sideways here. It looks like it had been going sideways for a month or two. And this is where you should be buying when it's first hitting new high ground, not after it's already run up over 5 or 10 or 15%, but after it comes out of the base. That's where you want to be buying. The other thing I'd like to say is that so many people for them it's very, very hard to buy stocks that are new highs. I think that old adage of buy low, sell high. People are saying, well, it's expensive up here, but if you thought Taser was expensive up here, look at the move that you missed, not buying it as it went into new high ground. And at first, it's very uncomfortable. But once you get some big winners that you've bought just breaking into new high ground and they take off, it's something you're going to want to be doing time and time again.
Right. This isn't an Armani suit that you're buying at Macy's and it's 70% off. And it doesn't work that way with stocks. All right. You get what you pay for. You're not going to get a Ferrari for a Hyundai price. And the stocks that are market leaders are going to appear expensive. So you got to get used to, like as Dave said, but we'll get into buying from bases and entry points and the real specifics of all this in a little while. But we want to also show you, we talked about how 96% of big winners come from market corrections, right? Well, there's a few things you need to know about this. And one of the pitfalls of trying to buy these market leaders is a lot of people will wait for the market to look good before they start putting on their buying cap. And by that time, the leaders have all moved up. I was a victim of this early on. I started off being a quant trader, and meaning I would form an opinion on the overall market, and then I would look for the best groups, and from there I'd look for the best stocks in the best groups and build my case sort of from market up to stock. And what happened was, time and time again, I was constantly missing the best stocks and wondering, why didn't I see those? Wow, they look so good. And in hindsight, I see where I should have been buying them, but I didn't see them at the time because I was too busy waiting for the market to confirm. And the fact is many of these leaders will start to emerge even before the market sometimes makes its low in a bear market. Now, this is what I call predictive. That's the first spot that you are going to be looking for a market leader. That's after the market's come off and it's corrected. Maybe it made one or two legs down, starts coming off the lows and turning up. You're going to start looking for these stocks. Matter of fact, when the market is in correction, that's when you really need to do your homework and start looking for the stocks that are holding up the best and the stocks that are building bases. And you're going to have usually three areas. Sometimes you'll have a whole bunch of names will emerge predictive. That was 1990. I found a lot of names that were predictive, that they're the Amgens, U.S. Surgical. I'm trying to think of some of the names, the power conversion, what was it, American Power Conversion. These were names that were breaking out and moving into new high ground before the market even ever made its low. And then the market went and made a lower low, but they made higher lows. Then you have where you'll have a group of stocks that will come, and sometimes you don't get many predictive names. It could be one of these areas, predictive, coincident, or confirming, or a combination of them. Coincident is a stock that moves out of its base right as the market is coming off of its lows, its final bear market low. And that's what I call a coincident breakout, or stocks emerging coincident with the market. And then confirming is after the market itself has put in maybe a big cup with handle and has moved sideways and built the base itself. And then you have a lot of stocks coming out of their bases looking similar to the general market. Again, 1991, going from 90 into 91 is a perfect example. Microsoft, Home Depot, Philip Morris at the time, they formed these big cup with handles, and so did the market. And coming, I think it was January 15th when we took off out of that big base. You had a lot of breakouts. And matter of fact, IBD, Investors Business Daily at the time, ran a headline that said, cup with handles proliferate. And they had a whole bunch of those little graphs and a whole bunch of cup with handle patterns that many of them went on to be big winning stocks. So let's take
Mark, on that. It was interesting. I actually went into Bill's office and said, this was right before we were going to get involved in that in the war in the Middle East. And I told Bill, I said, it's hard to imagine that this market is going to collapse when there are so many cups and handles. And I remember showing him a number of those. And then I guess a day or two later, he put those all on the front page of the newspaper. But lots of times, as you said, and it depends on how steep and how fast or how long the bear market is that some of these, the emerging leadership are breaking into new highs months before the market actually turns. So that's why it's so important to concentrate on what's starting to move, who's got the best relative strength, even as the market is coming down.
Yes, and as David just said, back in 1990, 91, I saw the same thing. I saw lots of stocks that were forming these nice bases, and I was smart enough at the time, I was still kind of green back then, but I was smart enough to trust the charts and buy these stocks breaking out. And at the time, the news was horrible. And some of the best analysts in the world were predicting, a horrible bear market that was going to continue. But the stocks told the story. Now, that exact same scenario has just happened in 2020, where we were just in our office, months back talking about how everything's so bad. Oh my God, coronavirus. And I said to my staff and my assistants, I said, look, the stocks are setting up. We're going to buy them. We're going to recommend them and we're going to buy them because the stocks are setting up and there's lots of stocks setting up and the stocks are almost always right. And if they're not, then we're going to get stopped out, but we're going to buy the names that are setting up. And lo and behold, it's been an incredible lockout rally. And we've probably had some of the most members that we ever had double their accounts. We have so many emails of people doing so fantastic. So that was all from following. If you were to recently I mean, look at the news with coronavirus and the economy. I mean, we're looking at numbers that are Depression era numbers. You wouldn't go near stocks, right? Back several months ago. Now, of course, it's looking a little more obvious now that we've been hitting new highs. Let me show you how this works in real life, okay? And we're going to go back to the 1982 bear market and the bear market bottom, and look at Walmart, which at the time, Walmart was just a mid-cap company that not many people knew. It wasn't the company that you would think of today, this big, certainly an institutional favorite. Back in this period, it was a market leader. And you can see here as the market comes off, and this was a very brutal, 1982 was a brutal bear market. There was a recession, and it was really tough times economically. But you can see right off of this first low here, as the market tries to turn up, you can see that Walmart is emerging into new high ground after it moves sideways in a base. But then you see the market rolls over and makes a new low, right? And the news is horrible. And look at what Walmart does. Walmart just comes back to the breakout point, moves sideways, sets up again. And as the market comes off its lows, it breaks out again into new high ground. It's totally predictive. I mean, this is really a great example of a predictive move in a stock where it's coming off of the very first low and the market goes to two new lows. And then again, you see, the stock just moving sideways, and then as it comes off, this is the final low, the bear market low in 1982. Now Walmart moves into new high ground again, and it's already up significantly from that first breakout. So this gave you a lot of heads up. But if you waited for the market, look, you're buying the stock way up here, extended, where you should be buying it down here and not worrying about the market so much. I don't look at the market very much. I look at the stocks, and if there's lots of stocks setting up, then I buy the stocks. That's really, I look at stocks before the indexes.
And this is very typical when a stock is when a market is in a bear market, the general market is in a bear market, but you have a stock that is breaking out in the new high ground. The weight of the market is going to keep that stock from really making a lot of progress, and then it breaks out again. But this is where it really explodes. So when the weight of the market comes off, it's almost like a beach ball that's been held underwater for a long time, and all of a sudden the weight of that comes off, and it starts flying. And that's what's so important of identifying those leaders even before the market makes its final low.
Yeah, and here's the really cool thing about this is that when you have a bear market, these stocks stick out like a sore thumb if you know what to look for. See, now you have something to measure it against, and you see the relative strength. And you will also see, if you're using IBD or MarketSmith, the relative strength number and the line will be very high and going into new high ground during this period because it's bucking the market, which will improve the relative strength and probably outperforming the grand majority of individual stocks. So you'll see these will have 99, 98 RS numbers and relative strength lines moving into new high ground. Now,
yeah. And one last thing. I mean, we're not at that section yet, but what is also happening from a volume standpoint is the stock is still moving up on good volume. But when the selling comes in, the volume is really drying up, and you can see it in areas like this. The stock goes sideways to down, and there's really not much volume at all. But when it starts picking up, it's just one other thing that we're going to get really into a lot of detail on.
Right. Let's look at Apple. So Apple in 2004 came out of this very nicely well-formed large base. But at that time, the market started correcting. We went into an intermediate term correction here. But again, you can see where we come out of this base, even as before the market turned up off its lows, very predictive. And then as the market goes to lower lows, Apple just forms another base and gives you another buy point. And then again, we go to even lower lows and Apple's forming another base with another buy point. You had 3 buy points that you could have bought. And this stock went up over 100% in just 6 months from here. And of course, we know, the Apple story going forward from there, it's going up even much more. But what you want to do is you want to learn to spot the strong stocks and chart the stocks against the market, particularly during bear markets, and buy as these stocks are breaking out, regardless of the market, whether the market is, in a correction, or at the very least, put these on your watch list, and you might see one that's, outperforming and coming out of a base. And then as the market goes to lower lows and turns up, you might get yourself another opportunity to buy it. Let's take a look at Amazon. All right. And again, the thing to remember is leaders lead. These stocks will lead the general market, and they will bottom ahead of the market. And usually what happens is they form a base in an uptrend while the market's in a downtrend. And as the market comes off the lows, they're breaking out of that continuation pattern. So again, for someone like myself or David, or someone who's done this for a long time, this just sticks out like a sore thumb. I mean, we can't miss these. It's so obvious. But if you don't know what to look for, then you'll miss it, and you won't see this, and you'll be late. So here, Amazon stock bottoms back here in 01, right? And turns up into an uptrend. Here's your 200-day moving average, 40-week moving average. You can see the buy point coming out of a nice, well-formed base here is coming right off of the market lows. You see the market doesn't bottom for another year, or even more than a year. The market doesn't bottom. The stock bottoms a year and a half before the market bottoms. And by the time the market bottoms, the stock is set up and ready to go. And right off the lows, this is a coincident move. Now we're looking at a coincident move. The stock breaks out right off the market lows. And then you see once the stock has already made a nice move, and the market is just starting to turn into an uptrend. The market is late. The leaders will always lead. It's important that you look for those leaders.
Yeah, one other thing is that you'll see that that you've marked in buy point, but then it gives you another buy point right here. And that's what's always interesting, is that if you miss the stock on the first buy point, there are so many ways of getting in, or there are so many more bases in when a stock makes a 240% move in 12 months. There'll be multiple times that you can get in. So don't hit yourself in the head for missing the first one. Look to the second buy point, the next pullback. And one thing, just to plug the sponsors of MarketSmith, that product, MarketSmith, is designed to show you these types of stocks. And so the philosophy, the Canson philosophy, is embedded in that. And it will help you find these types of leaders before the market starts turning.
That's right. The entire product is designed around the strategy that we use, that David has developed with O'Neill, and also to the back to where my trend templates are built into MarketSmith. So you can it's the product that you're getting with MarketSmith. Again, I'm not plugging MarketSmith because they're our sponsor. I've been using MarketSmith before we ever had a Master Trader program for decades, in one form or another. Before it was MarketSmith, it was Daily Graphs Online. Before that was Daily Graphs Printed. So I've been a customer of MarketSmith for 30 years. It's just a product that has everything that you need in one place, and you can't get it anywhere else, all this information. Let me move on here and show you eBay. This is another a stock that you can see, again, if you look at the development of where the stock bottoms in 01, and it's 2 years. Let me get my pointer. I'm pointing, but there's nothing pointing. It's 2 years before the stock sets up in a buy point and is in a stage 2 uptrend, turns in a stage 2 uptrend. But you can see the market. Here's the NASDAQ. There's where it bottoms, right? And so it sets up and gives you all this lead time. And then as the market finally bottoms, you're getting the leading stock setting up here and coming up. And this is more of a confirming type setup. Moving on to moving back to lumber liquidators. We looked at this before. Again, take a look at how this is one of the very first stocks to move into new high ground right off the lows. Again, a coincident move coming right off the lows, just as the market is moving off the lows, the stock is coming out of a ascending base here and moving into new high ground. Now, I'm talking about bases and some terminology, and you may not even know what we're referring to at this point. We're going to cover all this. We're not assuming that you know what these bases are and this terminology. We're going to cover it, and we're going to move forward with that. Right now, we just want to just show you just comparing the stocks versus the market. This is sort of looking at relative strength without a relative strength number or relative strength line. David can look at a stock, I can look at a stock, and we can tell you if it's outperforming and if it's relatively performing. I can look at a stock and tell you right away, I mean, with pretty good accuracy, if the stock's a high 90s relative strength, just looking at it, not even looking at the relative strength number in IBD. All right, let's look at Humana. This is going back, and this is timeless. All right, we've looked at stocks going back to the 1800s. Coca-Cola back in the early 1900s was basically was the monster beverage of that era. And it emerged from a pattern, very typical, cup with handle with VCP characteristics, had big accelerating earnings, was a small cap company that few heard of, and nothing has changed. Okay, these are timeless principles. That's the beauty of this. Is this will work for generations to come, and you can teach your kids to do this. Now, looking at Humana, right? And Humana today is a big company, right? So if we go all the way back to 1978, Humana was not a big company back then. Again, these were small mid cap names. But look at Humana coming out of a base, moving into new high ground, right, almost off the dead low. Almost off the dead low of the market. That's a coincident move, right? And I want you to look at the contrast. Look at the market in a downtrend, right? Below the 200-day in a downtrend. Look at the stock in an uptrend above the 200-day. Stage 2 uptrend. See, the stage 2 uptrend is already in place before the move starts, right? And it's bucking the market. It's in complete contrast to the market. So it's so obvious that you see the outperformance there.
And Mark, this is Humana as the market is in a bear market is just building one base on top of another base along the way. It's just a series of I call it. You can imagine it as almost steps where it goes sideways and then it goes up. It goes sideways and goes up. And as long as those steps are being built, then you've got a successful company.
Yeah. Yep. These are the base. Here we're going to have a battle of the tools. Now I'm using the tools. We have all these tools. David and I don't know what to do with it. We have all these tools. We're overwhelmed. We have all kinds of things we can draw, and there's some funny things like this. If you love it, I can put a heart. We can put little X's to show you things. So anyway, this is all new to us. So let's take a look at a stock that I made a really nice gain in a short period of time, and then it went on to go up several thousand%. I thought I was pretty smart, making almost a double on it in this quick move here, coming right off of the lows. And we have a special section on power plays that we're gonna talk about later. And this is a power play setup. But the key to look at here is that you want to be building your watch list while the market's in correction, and look for those stocks that are holding up the best and that are building bases and are breaking out first. You see, if you got too worried about the market correcting here, you may not have saw this stock breaking out and coming out of this power play, moving into new high ground just one day before the market makes a low. And again, this is getting that leverage that I was talking about, where you see the market moves off that low, it's up 18%. During that same period, pharmacyclics is up 90%. You see, you get that 4 or 5 to 1 leverage. This is how you get your leverage. This is how you leverage your account and make those returns. You don't need margin necessarily to get leverage. You need to be in the right place at the right time. Now, WR Grace, this was another one that was a big winner for me. It went up 147% in 55 days. I didn't get that whole move, but I got a pretty nice chunk of it. during that same period, the S&P 500 was only up 9%. I mean, you want to talk about leverage? That's like, 15 times the market, right? That's what I'm talking about, getting the leverage, buying at the exact right time, coming out of the proper setup and buying as it emerges. And again, you see how it's coming. Again, this is like a coincident move. It's coming right off the lows and just a little bit late off the lows, not completely coincident off the first few days, but in the first several weeks off the lows. Now, you might have a stock, something like a CMG, which this is a little bit later. You see that this is more confirming, where now you make the low here, but as you build the right side in the market, which you don't always get, sometimes you move straight up off the lows, you get a V bottom like we had recently, but sometimes you'll build that right side, and the stock will build a base along with it, and then start emerging as the market finishes its base building process. This can play out in a number of ways, and you could get a combination of predictive, coincident, and confirming, or you may get where you don't see hardly anything setting up in a predictive fashion. You get everything coming off the lows, and then you get some confirming. But you want to be looking at each of these key points and looking for these stock setups. Anything important to add here on these charts?
No, but you can just see on CMG that it's interesting how the stock is just getting tighter and tighter, even though the market itself is going down and chopping around. I mean, look how tight this is getting. And that's usually what you want to see before a stock really explodes and takes off. So volatility in the market, if it doesn't translate to the stock, that's going to be a stock that's about to make a great move.
And that's just my signature, my VCP signature pattern, which you see here: tightening, 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 and then really tight, which we're going to get into again in depth. But again, the tightness in price, key here. All right, let's take a look here. I want you to take a look at this stock here. Some of you may know right away what this name is just by looking at the chart. But I want to go over this and just sort of go over what was going on during this horrendous bear market. We're looking at the 07 to 09 period, or 08 to 09, which was just one of the most treacherous bear markets that I've ever been involved in. A very difficult market to trade at that time. This particular stock, all right, some of you can guess what it is. While the market is in this terrible bear market, and you can see it makes a new low, right? From this point here, it makes a new low. From that point to that point where the market made a low and then makes another low, this stock goes up over 100%. It makes a big move, and that's a complete a total divergence from the market. And you can see the relative strength line turns up here, of course, because it's outperforming the market, right? And then it goes sideways for a while, right? The NASDAQ hits a new low. The relative strength line hits a new high. The trend template criteria is now met as the stock moves up and the moving averages turn up. It's now in a confirmed stage 2 uptrend, right? After some time goes by and it builds this large base, and then you can see the general market starts to turn up. Now, the thing to point out here, and some people will get fooled by this because they'll look at this and say, okay, when this stock finally emerges out of this base, it's been underperforming. The market's been moving up, and now this stock's just moving sideways. That's because the stock is in its own cycle. It has already moved up significantly prior to the market moving up, and now it's just digesting that move and setting up in that continuation pattern. So again, if you're looking at it early enough and you're looking for those predictive setups, that you'll get a heads up, and then you'll be able to get involved in a stock here and understand where it lies within the continuum of price action versus the market. This is where I'm buying it right here. And this stock went up 500% from this point, and it's going up much further from there. It's Netflix, of course. And again, you see, looking at a weekly. Look at the prior uptrend in this stock versus the market in a downtrend and making lower lows, and then you go through the basing period, and then it emerges. This is more of a confirming. It breaks out in more of a confirming fashion, but it was predictive. It made a big move, and it gave you that heads up and got into that stage 2 uptrend. So that's one was a little bit tricky, and I just wanted to show you that. Looking
at Mark, a comparative somewhat. This comes to mind is Advanced Micro Devices now, AMD, which it also sat out for the first part of this bull market, or since March. There was a number of months where that thing was just going sideways, but then it announced good earnings, and it also got some good news from its competitor, and the stock has now taken off and is now one of the big leaders.
Yeah, and I tried to buy it a few times, thinking that it was going to go, and like you said, it kept moving sideways. It actually knocked me out of it a few times. I got stopped, and then we finally got it right as it turned up from that long sideways action, and lately it's been really holding up quite well. So DocuSign, again, going back to DocuSign, perfect example of a coincident move right off the lows. You see the market below the 200-day. DocuSign above the 200-day in an uptrend, and then moving into new highs, coming out of that base right off the market lows. That's another example of a coincident move. So what do you look for? We talked about market corrections are good. Obviously, they're not good if you get caught in them. You don't sell your stocks and take your profits and cut your losses, and you're holding through it, which you shouldn't be. But if you're able to follow the rules and get liquid, market corrections are great, because that's where the leaders stand out and give you an incredible opportunity. Remember, 96% of the big winning stocks, the super performance stocks, start off of a market correction. So that should be something that you are getting very excited about when the market corrects. Now, there's some things to look for. When you get a market correction, you want to start looking for stocks hitting the 52-week high list, because again, that's the market's correcting and hitting lows, and usually in a downtrend, and you have stocks hitting the 52-week high list. That's telling you something, that something's going on there. That's incredible strength. You also want to look for stocks that corrected the least amount during the correction. So if the market's down 25 or 30%, and you've got some names that only came down 5 or 8%, that's really good relative strength. That should show, that will improve the relative strength number and the relative strength line. And just by looking at those names, you're going to end up finding some leading stocks, because the price is telling you that something's going on. You also want to look at, and this was I think a good thing to look for recently when we came off of this V bottom. Look for some of the stocks that shot up the fastest and surged off the lows. So stocks that came off, but then were able to make up that ground and come all the way back very quickly. Those are also names that you want to look for, and then look for subsequent basing. And then you're looking for stocks that are building bases within the context of an uptrend. Stage 2 uptrend names that are building bases, and you want to see a proliferation of that. You want to see more and more stocks setting up, and the ones that are the early predictive leaders emerging, holding up, and then another wave or two coming after those stocks. And that gives you the confirmation that the market is getting close to a bottom, and that the leading stocks are telling you it's time to buy. And you'll very often also see a follow-through day around this time. You'll see accumulation in the major averages, and see some type of follow-through day on the averages like the Nasdaq and the S&P 500 or NYSE.
Yeah, and I would add to this is that when the market is either in a correction or a bear market, it's you can be very discouraged, and maybe it's months that you haven't made any money in the market, and a number of stocks start making lows, but then, as Mark said, some of them start holding up. Well, this is not the time to sit back and say there's nothing. I shouldn't even look at this. I shouldn't even go through charts. I shouldn't even look at the market. This is where you really want to do some of your best homework, or your longest homework, is starting to spot those ones that are holding up against the bear market, because those are going to be the big leaders. Because just about the time where you've just given up and you just say I can't find anything, that's when the market starts turning. So this is where you really want to spend a lot of time in doing your homework during a correction or during an ongoing bear market.
Yeah, the longer a bear market goes on, the more it weeds everybody out and they start throwing in the towel and giving up. And it's with me, it's the exact opposite. The longer the bear market goes on, the harder and harder I'm studying and looking for the gems, because I know we're getting closer and closer to a golden opportunity. So again, if you're licking your wounds and you've been beat up with losses, yeah, I can understand that you don't want to be involved in the market. But we'll talk about that and get you straightened out in risk management when we get to that part of the workshop. So we're going to take a break now, and this I believe we're at the last section for day one, and we're going to conclude here. But we'll come back, and when we do, we're going to get a little more specific and we'll start getting into that overhead view and getting a little more specific on the entry point criteria as we go into day two. So we'll see you soon.